Hi, Harris. It's such a pleasure to be able to meet you virtually. And thank you so much for joining me in the Market Goliath podcast. What you're doing is amazing, especially talking about investing and giving everyone an update on your portfolio. And I think a lot of people across the world would be keen to hear your story. You started investing in April 2022 and you're based out of Texas. I want you to tell the rest of the story. So tell me about yourself.
Kelvin, first and foremost, thank you so much for having me on your podcast. I'm extremely excited that we have the opportunity to talk today. And it's amazing how we are on two completely different sides of the world and we have the same passion. And we're here together today getting to talk about this. So, first, thank you so much for having me.
Let's get right into
Sure.
your investment podcast. Why did you start a podcast and what is the goal?
I started following the markets back in 2018. I was actually working for JP Morgan at the time. I literally got Robinhood, and I can tell you I didn't know absolutely anything. I just bought a couple stocks here and there, trying to figure it out. Fun fact I always like to say, back in 2018, I bought a share of Disney at like $80 and it's still $80. So, kind of interesting with that. I mean, a big thing for me when it comes to that is at that time, I was working on eliminating debt. I had about $15,000 of consumer debt. So what I did was, for a while, I worked at JP Morgan. I worked, my 40 hours a week. On my days off, I would work at a liquor store. And I was working 70 to 75 hours a week for a year straight. Between both those jobs, I only brought in like 45 grand a year. It was, very low pay. But with that little bit of money, I figured it out how to eliminate all this debt and I snowballed it really quickly within a year. I was living in Orlando, Florida at the time. At that point, I was not very happy with my career where I was going through JP Morgan. I packed up as much things as I could in my Honda Civic. I drove 19 hours to Austin, Texas. I moved to Texas and I'm now in the insurance industry. I've been with the same companies since I've been living in Texas and it's been amazing. Back in 2020, we all know what happened in 2020. That was a self reflection for me. What did I have to show for all my hard work? And I really didn't have a lot to show. So then I wanted to be able to buy a house. And the reason why is I live in Austin. Austin is a very big market for tech, and a lot of companies are moving here. We have the Tesla factories literally within 10 minutes of my house. We have Samsung now opening big factories over here. Oracle's moving stuff over here. Apple has big campuses over here. The average rent in Austin yearly increases between 20 to 30%. And I looked at that as like, can I beat the market 20 to 30% every year? Probably not. So I then, during that time, still doing my insurance job, on my like nights and weekends, I worked doing food delivery. And all of that money, I threw it into the side to build up a deposit. Was able to get the deposit down now in the home that we have. And then at that point, I know I established a home where we can try to, keep the growing cost as much minimum as possible. Obviously, there's still a lot of costs that come with a home, but compared to renting in Austin, at least, it makes more sense to own. And then at that point, this is what, January 2022, I started really getting deep in time learning the markets before I started investing. So then I started in May of 2022 to start investing my first couple bucks. And here we are today now, podcast over a year now, a 5-figure portfolio almost. The market has not been very generous the last month, so it kind of went down, but this is how we're at now. Why did I start doing the podcast? The first answer to that is I had absolutely nobody to talk to about this stuff. That's really really a big thing. But number two, I think of my podcast as like a diary. They're like journal entries. I want to be able to really document what I do. At the time when I started this, I didn't have a horrible salary, but it wasn't like the greatest. It's an average salary. And I really wanted to show that $1 invested is better than $0 invested. And it was building your portfolio based off of discipline and routine. And over time, you're just disciplined. No matter what happens, you stick with a program and you start reaping the benefits. And a big thing for me is there's so many people out there that I know who don't know what a Roth IRA is for like the US investors. they don't know what's even in their 401ks or don't even know how to buy a stock. If I can help one single person start their journey, that to me is the whole goal of the podcast.
At what age did you start?
So one of my regrets is starting very late. I won't count 401k investing because that's a little bit different. But as far as like myself investing, I started at 30. So I had a little bit of a late start. I mean, some people will be like, oh, I started at 40, I started at 45, I started at 50. So I look at that, but I see kids nowadays investing at 16, 17, 18 on their own account. It's right now you get to see, and that's one of the beautiful things I've seen like through Twitter or X. I see like a 20-year-old with like a $50,000 portfolio. And it's like, how the heck do you get 50 grand? It's amazing what you can see nowadays.
I think it's never too late to invest.
Mhm.
There's just so much value when you start compounding. You mentioned compounding, which is, I think, is the magic word when it comes to investing. So what does investing mean to you? Everyone's definition of investing is maybe similar, but I do find some nuances or discrepancies when I ask them this question.
For me, it can mean a lot of things, right? Investing can be obviously financial, but then it can also be relationships. So it kind of goes both in hand. The reason why I invest is to buy back time. To me, time is the most important asset that it's non-renewable. You can always make another dollar. You can never get back time. And I think to me, investing means buying back time. Now, a big thing with me with investing, I know there's a lot of people out there who are really big on the FIRE movement. I necessarily do not believe in the FIRE movement. I actually like what I do. I like going to work. I generally love what I do. But to me, I want to grab the FI part of it, financial independence. So then I have a choice of what I want to do. And I think that to me, what investing is in me being able to have options on the table instead of being like, I don't have any options. I have to work until this age because there is no other option. So I think that's what to me investing means in that sense of it.
What does financial freedom mean to you?
Financial freedom means to me that, and I see like, retirement's a word I don't like to use that often because to me, it's kind of like putting a death sentence onto you. This is actually through a fellow Twitter podcaster that I've gotten really good friends with. His name is Tom, the savings captain. He likes to use financial independence more than retirement because like retirement is like putting like a death stamp. And I've kind of also kind of tried avoiding using that term. But financial independence to me is like, hey, can we do this trip to Europe without having to break the bank or even touching anything? Or, hey, can we take this weekend off and just go explore? Hey, can we do this home renovation without having to take any debt or having to do anything like this? So it's a lot of definitions of it, but it's just having the options to do whatever you want to do without any repercussions. So I think that to me is what financial independence will get to. A big thing that I've thought about, with what the goal of the portfolio is right now, if you ask me today, I don't want the portfolio to pay for all the bills right now. I think more the way I'm thinking of it as is like supplementing, whether it's like for a home renovation or whether it's for a big trip or for any other maybe investment outside of the stock market you want to do, is being able to pull that and then allocating that to another asset or just another project per se.
I know you started building your portfolio, and what is the investment philosophy behind it? Are you a value investor or growth investor? Let my audience get to know your investment philosophy a bit here.
So I would consider myself a dividend growth investor. I'm a little bit more conservative, to be completely honest. So for me, I, for the most part, invest in very blue chip companies, blue chip stocks. I'll get heat for someone saying, oh, that's way overvalued. And it's like, and then you get in that discussion with somebody who does main into value investing, right? And it's like, if I look at some of the metrics for like, I'm going to give you a ticker as an example. This is something that I do hold in my portfolio, waste management. It's the best piece of trash you can ever buy is always the joke. It is overvalued. However, in the US, it's almost a monopoly. It practically, I think, owns like 70% of the market for like trash and recycling. And to me, I'm okay paying a little bit of a premium on that holding just because, it's a business that isn't contested and we're going to need that service for the rest of time unless somebody comes up with some crazy way to how to literally safely eliminate trash, right? So I invest in very blue chip companies. So I did listed like, waste management. I have Johnson and Johnson in my portfolio. I have McDonald's in my portfolio. But the way how I've allocated this portfolio is ETF, exchange traded funds, are the heavier weighted across everything just due to risk mitigation. I know what my risk tolerance is. And through the ETFs is how I've been able to get that exposure to the growth companies that we all know, such as like Tesla, Microsoft, Apple, all that. I don't own those individually, but my ETFs, I get that exposure to everything. I'll get exposure to small caps, mid caps with VTI. It just been able to spread it out. And then there's like sectors that I'm going to be honest with utilities. I have no interest in digging of any into those. So I just literally ETF it out into something called XLU, which just is, little basket of funds with all these utility companies. So right now I'm at about 60% ETF, 40% individual. The goal is to get that to 75%. So it's just mixing in mostly ETF and then mixing in individual companies that I either use every day or I have a very strong basis or thesis behind it.
Do you feel like your investment philosophy has evolved over time since you started your podcast in 2022? What I've realized interviewing so many people or other investors across the world is like their philosophy has changed over time. Maybe started from Warren Buffett, but it has changed into a bit more growth, a bit more dividend. So how do you see this change for you?
Great question. So the way how I've changed is in the beginning, I really didn't care that much for ETFs. I had some, right? But the allocations, we could flip it. I think it was like 80% individual, 20% ETF. And as I started learning and going, I realized that beating the market's not the easiest thing to do. And that's where I started learning about my risk. And that's how I really started being to evolve into now where I know that being ETF heavier is more beneficial for my family and for myself. If the market was to take a 20% correction with the ETF, it's going to hopefully be able to absorb better with a 20% reduction. But the caveat to it is, oh, but what if you get this individual stock and it, 2X's, 3X's, 4X's? I don't I don't try to play the 2x, 3x, 4x game. If something in my portfolio does it, then great. But I know realistically what I can handle risk-wise, and that's what's based on what I hold in my portfolio. If I wanted to do something risky, if I ever wanted to get to that point, it would be less than 1, maybe 1.5% of the portfolio if I wanted to dabble or try something.
I think that there's a similarity in terms of why we started our own podcast, especially when it comes to investing podcasts, is to share financial literacy. And there's a aspect of picking stocks or studying companies. I think it's quite difficult to study companies because there's a lot of behavioral aspects applied to it. For example, studying the management team, understand their thinking. But a lot of it, as you mentioned earlier in the podcast, really comes from self-discipline. That's where we feel we can add a lot of value to our listeners. And how would you describe the behavioral aspect of investing, which is so challenging, but at the same time, it's something that you can change that will help you to become a better investor?
Behavior, in my honest opinion, and emotion is everything with investing because when you get emotional, you make rash decisions. Maybe you make a call that's too quick, whether it's like, for example, cutting a stock that's on the run up and, are you cutting off a run up or if it's going down, are you looking at the full picture? Why did it go down 10% today? Why did it go down 5%? And I have a rule where, for example, if let's say hypothetically a company cuts its dividend, for example, or if there's some news, some headwinds in the company, I have a rule. Once I've discovered that, I don't sell at least until 2 weeks after if I'm going to do it, because I need to take time to digest, absorb the information, research the information. Now, if the CEO did something really, 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 really messed up, that it's like really unforgivable, then like that's the exception, right? But a lot of people get too quick to cut things off and they maybe make an emotional decision. I'm going to use a stock I used to hold as an example was Intel. Intel, they cut their dividend earlier this year. Luckily for me, I got into Intel very early on. So my cost was like in like $26, $27 range. And when they cut the dividend, I took 2 weeks to absorb that. And for me, I did sell it. I was able to get a 10% gain on it. But the reason why I sold it was I looked at my whole portfolio and then I saw that through one of my ETFs, I had a decent exposure to semiconductors that I could live with. And also, semiconductor is something I didn't feel fully confident in. So I was able to see I have semiconductor. If I was to cut this off, I'm not really going to miss it. So that's something that I did do there. As far as with like the emotional part and, with everything and setting a discipline, you have to pay your mortgage or your rent every month, right? You have to pay your cell phone bill every month, your electricity, water every month. That's how you should treat investing. You set aside a specific amount of money, you invest, whether it's monthly, by whatever rule you want to put for yourself. I do it every 2 weeks. No matter if the market is red, green, yellow, purple, blue, I put in that contribution every 2 weeks, no matter what happens in the market, because it's more about setting the habit and getting into it. A fun fact is it normally takes a person about 62 days to be able to develop a habit. And it comes to the point where you're making your contributions to your portfolio, you're literally doing it without even realizing it. It just becomes second nature. So I think that to me is what the most important thing with investing is. People are like, oh, I want to wait a little bit. It's like you're timing the market. You're trying to be greedy. Just set, forget. Best way I can do that.
How do we sort of approach life the same way as investing? Because I think it's quite hard to separate being emotional in our everyday life, especially when it comes to relationships. I think
Mhm.
it's hard for people to separate that and apply that to investing. I feel like a lot of businessmen are really successful. They're the ones that are very unemotional. And I think that if you were to apply that to investing, I think it would be quite applicable. So how do you approach life the same way as investing?
I do in a sense of as far as like when we need to make like big decisions that are, whether it's like buying a home or making a move across state or anything like that. Before you make the decisions, I like to write things out on like a notepad and start writing out pros and cons to everything. If I do this, what are some repercussions or what are some benefits I get? And then you have to analyze everything and then you kind of use common sense if this makes sense. A big thing for me was like when I was buying a home at the time, I knew interest rates were pretty low when I was able to get in. And I know it's like, this is the opportunity to do this. And the mortgage, 1% difference on your interest rate changes your payment drastically. So I know this is the time to do this. And look, I got a 3.3 interest right now. Homes are going for 7, 8, 9%. So like that to me, locking that in was like a no brainer. And I did that by just like taking my time to research, doing the math, looking at if I was to stay renting, we know that 20 to 30% increase every year. With a home, the yearly increase has been less than 10%. So that's just things that I like to approach with. It's just analyzing it, not being emotional, right? It's not like, oh, that house is really big and I love it. Nope. Let's take a step back. Let's look at the data and let's look at the information as far as like on a 5-year period. Would this make sense compared to this? I like to use 5-year periods to compare a lot of things.
I think it's important to zoom out. I know you did an episode on why it's important to have a vacation. It's almost like zooming out and seeing the big picture. It's applicable to those people who actually track their portfolio every single day. But you need to have some sort of emergency fund from time to time. Talk about time in the market versus timing the market. I think a lot of people get confused. And I know you spoke to a lot of other investors on this concept. So for my audience on the other side of the world, what does this mean?
So it's time in the market for that part of the term is essentially participating in the market on a 10, 15, 20, 30-year period. I don't have the chart in front of me, but I think after 15 years, I think 90% of people who have been invested that long are in the green. Obviously, if you look at the shorter term, it's obviously lesser, but then you start going over time, more green because people are just letting time and compounding doing its thing. Timing the market essentially is I'm not going to put any money into here or into this holding or into my portfolio until X happens. Now, if it happens and you're able to do it, which is almost very hard to do, great for you, right? However, by you deciding by not doing that, sometimes people miss out on the 9 best buying days of the year, and buying on those best days is what's going to set it up for the 10, 15, 20-year part down in the road. So waiting for something to happen and you're just sitting on cash, maybe it takes a year, maybe it takes 2 years, maybe it never happens. And people get so caught up on that. It's like the people that tell me I won't invest in Apple until it hits $100 a share. As far as like recently, I mean, it reached the 120s this year. In my opinion, that was very low for Apple. So it's like people have these hard set numbers and they won't break out of it. You have to have an open mind, right? I'd love to get Apple under 100. Who wouldn't want to get Apple under $100 a share? What are the chances of that happening though? And that's what you got to look at. I'm going to use a ticker that I hold as McDonald's as an example. McDonald's is overvalued. I know it, but I understand their business model. I understand how they make money. It is such a amazingly run business. And right now, through social media and through their TikTok and all these trends that are coming up, they've been able to hit all these new target audiences by all this different marketing that they're doing, and their sales have been going up. And right now, I think year over year, they have like about a 10% increase on sales. The big thing with McDonald's is if I said I'm not going to buy McDonald's until it's $200, is that going to happen? A big mistake I made was back last year. I've been watching McDonald's for a very long time. It wasn't until like August that I added it. When McDonald's pulled out of Russia, I was scared to invest in McDonald's because I was worried about how much of the sales were going to take a hit. And I said, I'm going to wait it out. By waiting it out, it went from the 220s almost up to $300. Right now it's in the 260s because, over the last month it's been correcting. So what I've taught myself is if there's a holding that I absolutely love and maybe I don't necessarily love the price, it's buying it in small bits and pieces. In today's age, we have the huge benefit of being able to buy $1, $5, whatever dollar amount we want into holdings and build it out slowly. Compared to we go 20, 30 years ago, you had to maybe buy 100 shares at a time. So now we have that ability to put in what we can. So with something like McDonald's, I'll buy it in small bits and pieces. Right now, if it has a correction, then I'll put more into it. But at least slowly adding over time and building out the position is something that has worked out for me.
I think it's a very important concept to understand the difference between timing the market versus timing the market. I feel like a lot of people don't get that or can tell a difference in terms of managing a 10,000 portfolio and continue to grow it. What are some of the learnings from studying all the companies and doing a review every month? And obviously you mentioned this is like a diary for you, but what have you learned from that process?
One thing that I've been able to learn is the bigger the portfolio gets, the easier it is to see the red or the green or seeing the bad days or seeing the good days. So when I started off, I'd see something fall 5% and I start getting very anxious. Now I'm at the point where if I see something drop 10, 15%, the first thing I do is like, is the reason why I'm investing in this still the same? Yes, don't care. I'll average down on it over time. So I've been able to take that emotional part, which is seeing the up and down, a lot easier as the portfolio has been growing. I know people, they have like 7-figure portfolio values and they're like, I lost 30 grand today. It's okay. But then, you're just used to it. And that's something that I can say that happened to me. But then also I have been able to really challenge myself with reading. Before investing, I'll be the first one to say I absolutely hate reading. I don't like it. But doing this has challenged me to do something I don't like. And I've been able to improve on a lot of aspects of to that. So learning different things, for example, understanding one company, what are all these brands under this company? It's just understanding the diversification. For example, in banking, I know every type of the different banks have different type of risks that they're investing in, understanding what is the most of their capital allocations going, with the funds that are coming in. So it's just understanding little bits. It's every time I like to tell people, what's your favorite real estate company? It's like, I don't know. Well, it's McDonald's, but it's a little tip. It's like that. And you get that through reading 10Ks and just being able to, read blog posts and being able to watch other content creators talk about these stocks. And to me, being able to learn, okay, we all know what Johnson and Johnson is, but what are all of the kind of like the pyramids or the umbrellas under that name that bring in the revenue. And those are the things that I've been able to really learn.
I follow you on X and Twitter, and I'm sure the investment community there is pretty big. I think there's a lot of noises. How do you filter through, useful information from those that are maybe just noise? I think as retail investors, it's always difficult to shut out the so-called noise. So how do you filter the information?
So one thing with me that I'm very big on, if somebody has a different investing philosophy, I don't automatically start like, oh, this is stupid. Like, no, I'll be able to tell you that I've been able to learn really great lessons from people who have completely different opinions than I do. So it's having an adult conversation and learning from each other. And I think that's what's the best part of it. Obviously, not every conversation is going to go like that, but being open minded and being able to listen to somebody's different point of view maybe can teach you something new for yourself. And that's actually something that happened with me with like my change from like going heavier on individual to ETF. Like I was literally having a good conversation with somebody in the community. But, you know, on X or any social media platform, there's always going to be some things that like I don't see how this is viable or how this is going to work or how this fits my bill. I just scroll, right? I don't poke the bear, be like, oh, what's your thesis on this? If somebody has like a really interesting view of like an individual company, ask them, hey, I'm just really curious, why do you think this? And then have a healthy dialogue. But, just like anything in life, there's a lot of things out there that don't fit your bill. Just know that understanding your conviction and your risk is the most important thing. Never copy anybody because what their conviction may be may not match up with yours. What their goal may be with that fund may not be the same for yours. So it's just understanding that. But then the best part about this is I've been able to interact with people across all the world and have like DM conversations with. And the goal of the podcast was to talk to other investors, and I'm getting that. So that's to me what's the beauty about having the technology. I think people like to focus a lot on the negatives, but we have to really hone in on the positives of everything.
I'm really curious to know because I know a lot of your holdings in your portfolio, a lot of them are dividend stocks. And especially in a interest rate environment like today, there's definitely a lot more attractive stocks that give out a very attractive yield. Do you think it's dangerous for investors to chase yields,
Uh,
given that there's so many options out there?
Absolutely. But I'm going to tell you unhealthy ways to chase yield, but maybe positive ways to chase yield. There's a caveat to everything. Chasing yield is most of the time people get burnt on it. For me, I used to hold AT&T, kind of the same thing. I got in really low with it. I sold at a 10% loss just because it got to the point where I asked myself, can I live with that? Can I live without this company? I said yes. But I started looking at their debt ratios and how debt intensive that industry is and how competitive it is. I'm like, you know what? I can live without this, right? But I know people that have average cost of AT&T still in the mid 20s, maybe even early 30s. And that's a big hit. And it's because it's chasing yield, right? The same thing can be applied to like stocks that I don't own, like Walgreens is an example of one that people have gotten burned on. MPW is one where it's a real estate for hospitals. That's one that people has gotten burnt on. Zim, the shipping container company, that's one people got burnt on. For me, a big rule is if I start seeing too many people talk about it, it's like if your Aunt Sue comes to you and goes, hey, I want to buy Zim. It's like, how the heck do you know this? That actually happened to me with my sister-in-law who doesn't know anything about investing, but she says, oh, I'm buying Altria Group. I'm like, how do you even know what this is? Now, Altria Group, you're looking at total returns. It's been one of the better, higher yielding stocks, but I have a red flag when somebody brings that up. But I want to be able to bring yield in a good and positive way. Something that I like to use is what's called dividend yield theory. So I like to look at how is the current yield measuring out to the 5-year average. And I like to compare that. For example, Discover Financial Services is a financial stock that I hold. Right now, dividend yield I think it's about like 3.5 to 3.75%. I don't know like the exact number because I haven't looked at it over the past week. But the average is like in the low twos. Same thing with like Johnson and Johnson. I call it the sweet spot, and I'm going to put air quotation marks because that's my opinion on it. If Johnson and Johnson hits a 3% dividend yield, which it is right now, whether I'm in the green on it or not, it's just a good opportunity to add a little bit to that. So chasing yield, there's obviously a negative to it, but you can also make a positive out of it. It's just understanding, again, risk. If you're going to invest into this, what is the allocation you have in your portfolio? So one thing that I want to look out at is that Starbucks is very low percentage wise in my portfolio. I'm in the red in it now. So it's like, you know what? I have not added the Starbucks in a minute. That might be a good time to look at that. And I start comparing the dividend yield versus the 5-year, or looking at, current pricing. So that's the two caveats of dividend yield. Is you got to be careful with it. If you want to chase something, set it as like less than 1% of your portfolio, and just to test it out. There's nothing wrong with testing out anything, because, if you don't try it, you don't know. A lot of people on Twitter are like, oh, I'm down 50% on this, but it's going to turn around. It's like, it's kind of scary to look at that.
A lot of retail investors actually get carried away with yields, and they look at the stock price too. Because if, let's say, you buy a stock that's $200 a share, like, you have a capital problem, right? If you don't have a lot of capital to invest in these stocks that is pretty expensive, that pay a yield, you're not going to get a lot. So it's important to study the underlying asset. What is the opportunity? What are the risks? I think a lot of people don't do enough of these SWOT analysis. You mentioned covered call ETFs before in one of your most recent podcast recordings. I'm sure a lot of people have not heard of a covered call ETF. I think it's more technical, but I've seen people in the investment community, they've lost a lot of money from covered call ETFs. So tell me more about the covered call ETF. What is it?
So essentially, what a covered call ETF is, it's an actively managed ETF fund that buys a specific set of stocks, and they write call options on them. Now, essentially, a lot of people do their own options trading. Options trading for me is something that I'm not ready to incorporate by myself, because I have so many other things I want to do before doing it. I see the benefit in it, but I'm not at that point in time yet. Just because everybody else is doing it, maybe are you ready to do this or not? And you don't want to jump into something not understanding something fully and then making a mistake that costs you a lot of money. There's a bunch of different funds for these. So for example, JP Morgan has a couple holdings. They JEPI, JEPQ. JEPI is the only one that I actually hold. It is the lowest allocation in my portfolio. So like I said, it's risk, right? I know it is probably the riskier holding that I have. It is the bottom of my allocation, but then I know that they write calls on Microsoft, they write calls on Amazon, they write calls on MasterCard, I believe, and Adobe. So they'll pick out, hey, for maybe the next 3 months, we're going to write calls on these particular stocks. Then there's like the Global X funds, which is like QYLD, RYLD, XYLD, which I know that's the one that people know that they got burnt on. And then now the new ones coming out, which they write synthetic cover calls, are all the Yield Max funds, which is like the Teslas, the Appleys, NVIDIAs. I can't even say the pronunciations for them, but those are one ticker that writes synthetic cover calls for only one holding. Benefit to these is getting income now. However, you have to look at it at what age you're at and you're investing. If you're like in your 50s or 60s, you need the income now, it might be the best option for you. If you're younger, may not be the best option. The biggest thing with these is understanding that what kind of job does this do in your portfolio? And you have to understand expense ratios. They're not cheap to own. That is the first rule with these cover calls. A JEPI, which is the one I chose, has a 0.30. And believe it or not, that's actually one of the cheaper options. If you go into like the Global X, they're like 0.60, I believe. So that's double the price as far as your fees. So understanding fees for these are very important. But then the other part of it is understanding about, the capital you're putting in. Is it going backwards? Is it staying linear, or is it going up? For JEPI, I know that my capital contribution has been pretty much flatlined. But I know that the job for that covered call ETF is to be able to generate between 8 to 12% total return. Ever since I've had the holding, it's done that. I've been double digit total return on it for pretty much almost the entire time, except for now because of the correction in the market. But still, I'm at almost a 9% total return. So understanding that, what job it has in the portfolio, you can work with it, right? My goal with JEPI is I have no intention of selling it because it's such a new fund. I also want to be able to learn more about it, right? And I think having a part of it invested into it is very helpful. But I'm not going to make that 5%, 10% of my portfolio. I will never let that exceed 2%. So as time goes on and, as that position grows out, it'll come to the point where, say, if I get like $40 in dividends from it at one point, I mean, I'm not going to keep reinvesting into it. I'll grab that money, put it somewhere else. But still, if I look at it in a total return, it's doing its job. And that's what you have to look at with these and the risk. A big thing with like the yield max funds are very popular right now. I question how sustainable being able to give people 50% return through writing these cover calls. How is this going to be sustainable? And a big thing you want to look at is the NAV factor into the holding, because you want to look at, are they returning to you your initial capital back? And if they're giving you the dividend, which is grabbing your initial investment and just giving it back to you, that's very dangerous. I have no desire to participate in the yield max ETFs. If you want to try it, that's on you. Like I said, just know that maybe don't buy 100 shares of it. Maybe buy 5 if you want to, and just to learn, see how it moves and make a decision from there. All of these holdings are very risky. Even the one I hold, I consider it risky. So it's just be very careful. Another thing to look at with these, with like a blue chip company like Johnson & Johnson or anything like that, you know what the quarterly dividend is going to be, unless if they do a raise or if they do a cut. With these type of calls, they fluctuate. So it goes based off the premium received and what they're able to do their distributions with. I'll see people goes, oh, they just did a dividend cut, I'm cutting this. Like, did you read what the fund does? Like, the fund literally is like, it depends on what the premiums are. So you have to understand it's going to fluctuate and accepting that. So for me, as long as it's hitting the goal of hitting that 8 to 12% total return, it's doing what I expect it to do and willing to hold that.
Thanks for defining what a covered call ETF is. I know we're almost out of time here, but I think it's important for every guest to share one of their biggest learnings or mistakes when it comes to stock market investing. What is it for you, Harris?
That's actually a very easy question. I have a rule: no individual holding above 5% of the total portfolio allocation. I broke that rule last year. When I started my Roth IRA, I did lump sums and I put a little bit too much into realty income. At the time when I did that big lump sum, it was 14% of my portfolio. Obviously, we know that real estate is getting absolutely clobbered right now. One, due to interest rates. Two, a lot of people who invest into real estate, a lot of older people looking at right now, it's like, why would I get a 5% in yield real estate when right now you have CDs or high yield savings accounts or treasury bills? For the right now, you can get that or a little bit more for no risk on capital. And for some people, with how the volatile the market's been over lately, it makes more sense to them just to pull out of that. So that's also another negative effect it's having on that. So realty income is my biggest loser right now. My thesis doesn't change on it. Their occupancy rates at 99%, their portfolio is diversified. Most of their debt is at a 3.5% interest rate and it's locked up for the next 5 years. But obviously, the negative sentiment around all that is still going to affect the stock price. So by allocating too much, I took a bigger hit as far as the right now paper loss, right? Because I'm not going to sell out of it. I'm going to work onto it. I'm at about like 8.5% on it right now. I haven't sold or trimmed anything, but that's just to me like adding to all of my other allocations. It's slowly bringing that percentage down. So by breaking my own rule, I put too much risk into one position, which is now holding down my portfolio paperweight wise. So that is the lesson from that. Once I get realty income below 5%, whenever that happens, I will never let a single individual position exceed 5% because of risk.
Harris, I think you just opened a can of worms because Realty Income Corp, ticker symbol O, is probably one of the most talked stocks, given that they're all saying that it's very attractive now in terms of valuation and there's a lot of upside in the future. How do you personally see this stock?
Right now, in my honest opinion, so it's not financial advice, it's just my opinion, it is attractive. However, if I want to average down on it, I'm not going to go doing 5, 10 shares at a time. One, because then I'm just going to keep increasing the allocation, and I still want to stick to that rule. I need to get this lowered. Maybe buy one share here and there just to kind of average down, but making sure that everything else is being built out. A big thing with Realty Income, they have over 100 quarters consecutive of dividend growth. They have made every single dividend payment since the mid 90s when its inception. Their occupancy rate is very high. It's good they have tenants paying in. They're very diversified. A big part I know of their portfolio is like the dollar stores. And I know that part of retail has been having a negative sentiment for this year. If you're going to invest into real estate, know the tax implications. Most of these are held in a tax advantage account, so I'm not getting hit with taxes on this. So that's a big component to this. But if you want to start dabbling into it, I mean, we're almost at COVID levels when, as far as pricing wise, it hit, I think, like that $42, $43 range. We're getting pretty close. And I think under $50, it's pretty attractive. But obviously, do your own research, understand the risk, understand the implications of, how I think that at least for the next maybe 15 months, we're going to still see high interest rates. How low can it go? And that's the big question that I do with real estate.
Thank you, Harris, for sharing that. And I just want to say thank you so much for your time. That pretty much wraps up today's episode. It was such a pleasure to have you on, and I personally got to know you better as a investor and your investment philosophy. And I can't wait to see you grow your portfolio from 10K to 100K. It's only a matter of time.
Kelvin, the day we hit 100K, I will fly out to Hong Kong. We're going to go party.
I'd love to take you around. So for my listeners, how do they find more information about you and your podcast?
Through Spotify, Apple Podcasts, Google Podcast, any podcast provider, 1 penny at a time is the way you could find it. On Instagram, you could find me as 1 penny at a time podcast, or through Twitter, X, whatever you want to call it, 1 penny podcast. Pretty simple for that.
Brilliant. For my listeners, you know where to find Harris, and do follow him. Thanks, Harris. It's such a pleasure.
Kelvin, thank you so much. It's a huge honor to be able to speak with you today.